Annuities, how do they work? Do I just hand over my money to some insurance company and pray that my financial future is safe? Well, in today's video, we go and look deeper into how an annuity works. In most of my videos, I do talk mathematically about how things do work, but in today's video, we're just going to go over the basics of the annuity, my Annuity 101 playlist. You can check it out up here. If you do have any questions, particularly to annuities, please let me know and I'll address it in a future video. And be sure to hit the like button so that the math budget can continue to be funded and we can go in super nerdy from next week on in covering more topics about retirement planning and investing. Alright, so if you haven't checked out the What is an Annuity video, you can go check it out up here or in the comments below. I'm going to talk about those two different types of annuities and their subcategories and how they actually work. Now let's cover those deferred annuities first and break it down from the beginning with the most simplest annuity, which is the fixed annuity. Fixed annuities can be fixed over a certain period of time for a certain guaranteed interest rate. These time frames can last between as little as 1 year or have multi-years of a fixed interest rate, which will then default back into a minimum guaranteed interest rate where the annuity policy will be until you take out the money. Number one, these annuities are very safe. The principal and interest payments are guaranteed by the insurance company. The second benefit for this is, depending on the length of time, they can be a lot higher than the CDs you can get from the local bank. Lastly, your payments are guaranteed. At least you get your principal and guaranteed interest payments back for as long as you have the insurance contract. The second deferred annuity is the fixed index annuity. This one's a little bit more complicated. Let's slowly break it down. First, the principal is guaranteed while the interest rate is determined by the performance of some underlying index. You normally have a participation level or rate and an interest cap. Unlike the first type of annuity though, these index or crediting rates are not guaranteed. They can change based on the company's performance and their outlook, and also keep in mind that on the contracts you'll see what the guaranteed minimums are, so please take a look at those too. And lastly, the last benefit of this is there is normally no fees attached to this. Be very careful because slowly as these products are becoming more and more accepted, fees are being slowly snuck in there, so be aware. Also, one last thing about a fee, a lot of times you hear what's called a spread. A spread is very different from a fee. A fee is charged on your account. A spread is kind of like a performance bonus that the insurance company gets to take if they beat or if they give you return. For example, if the spread is 1% and your balance or your account grows by 10, the insurance company takes that 1% and gives you 9. If, on the other hand, you had a 1% fee, then the 1% fee would take the entire balance of your account, assess that 1% fee and charge it to you on the year end regardless of asset performance. So you could lose a lot more than your interest credit if you choose the fee route versus the spread route. So keep those two in mind and keep them separate. They are very different ways that an insurance company would charge you or assess you a fee. The last type of annuity is the variable annuity. Now these annuities are going to have the most risk. As you notice, they are the only one with the word variable in it. The other two had fixed. Principal is not guaranteed and the interest rate is determined by the performance of underlying investment accounts. So unlike the first two, this account or this annuity is dependent on direct investment performance, not based on any type of crediting system based on an index, but based off of a investment, either a mutual fund, an ETF, or some kind of other investment option. And another thing about fees, these annuities can have fees related to, number one, the investment. So like a normal mutual fund or an ETF will have some kind of management charge. So will these annuities. And the variable annuity also has what's called a mortality and expense fee. These are standard with most annuities, but only in the variable annuity will they actually charge you for it. Typically, an M&E fee will be anywhere between 1% and I've seen upwards of 1.6%. And this is based off the asset. And what this charge is for is it's for the guarantee that if you were to pass away, your premium payments, so all the money you put in, would be then given to your beneficiary. It's like basically like you're buying life insurance on top of your asset. And again, that M&E fee only works or only pays out to your beneficiaries if you yourself have not taken any distributions from the annuity. Now, lastly, these annuities can go all the way down to zero. I doubt that they will, just primarily based off the fact that most of these are invested in mutual funds, and the mutual funds typically are picked and designed by your planner or your financial advisor. So, I mean, they could theoretically go down to zero, but most likely will not. You just have to address or assess the performance similarly how you address the performance of anything. And you can check my video on how to properly address or assess your performance. So that's how the deferred side of the house works. Let's look at the immediate side of the house. This one's going to be a lot more simple. In the what is an annuity video, I talked about taking a lump sum of money, dumping it into an insurance company, and getting a lifetime income stream. It's the same thing. The one risk, though, that you do have with an immediate annuity is the fact that once you commit to it, you can't get the money back. So, for example, that $1 million that you do send to the insurance company to start your income stream is pretty much non-returnable. You will have to get some kind of a extraneous circumstance or anything to even start getting that money back within a couple months of you putting it. It is a contract, and the contract says that you are giving money to the insurance company in return for those income payments. And once those income payments start, typically you cannot renege or cancel that contract. So here's the fun part. Lastly, we have a combination of the two where we have a deferred type of annuity, and we're going to turn it into a immediate annuity sometime later on in the future. Now, in the old days, traditionally, you would do that with a deferred annuity. You would wait till maybe you hit 65 or 67, and then you would annuitize the contract, thus turning it into a stream of income. Now, more recently, there have been introduction of things called income riders, where you have your cash account or the account that has all your cash value in it, and you have a separate ghost account that is pretty much just for accounting, and that's referred to as your income base. And after you reach a certain age, the number in the income base is the percentage or is the base number they use to calculate the percentage of income you can take from your cash value, and that value will last for the rest of your life. Now, it sounds very confusing, and it definitely can be, but if you want me to go further into how an income rider works, you can go and leave that in the comments, and we can take a look at some of the different products that income riders are a part of. Now, the benefits here of using that rider versus just simply annuitizing is there are about three of them. The first one is that you can actually have cash value growth and have income rider benefits. So what that basically means is while you're pulling out income, your cash value can still prop up or still build more credits onto your ghost account in that income base. Second is if you do pass away early, the cash value in your account is usually returned to you or your loved ones when you do die. And lastly, even if the account value or the cash value of your annuity goes down to zero, you're still guaranteed that percentage payout based on your income base, not on that cash value. So you can see your worthless asset still providing you with a stable income. Now, that was a very top view, 10,000 feet above view of how annuities work. If you do have any questions, leave them in the comments, and I'll see you in the next video.